Hello and welcome to another edition of Deal Hunter. I'm your co-host, Mitch Flax, founder of Net Equity Capital, alongside Tom Staub. It's always great to see you, my friend. How are you?
I'm good. We have more deals than we can handle right now, flowing in.
I love to hear that, man. Obviously, a lot of turmoil going in the markets as we speak. I think the stock market is crashing today. Everybody looks like they're just selling into any sort of rebound. And I know investors are probably frightened right now of their invested assets in the current market, perhaps in the real estate market as well. All assets might be a little dicey. A couple of things that we definitely want to talk about today. But before that, by the way, how do we like my new camera?
That's
What do we
great.
think?
That's
I mean,
fantastic.
I feel like I got a makeover. So
Yeah, I mean, I'm telling you, a camera is the modern day suit.
I love to hear that, because I don't wear suits anymore. Those, I mean, I've got like 10 of them and they're all out. So I'm not wearing them anymore. So I will take this good camera. Thank you, Logitech.
That's right.
And Amazon. By the way, I don't know if I told you this, but I passed my level 1 Kaya exam. So pretty exciting. And I'm about to go into the hole of studying for level 2 and completing this thing. I saw a job offer, well, not really a job offer, but ultimately one of those links, you know, I'm somewhere where people are recruiting you. And the Texas Municipal Retirement System was looking for a private market director. And they had a requisite that you needed one of 2 designations, which was one, either the CFA or the Kaya. And so I felt really good about myself ultimately. So I'm feeling myself today. I've got a new camera. I passed level 1. The market is going to hell in a handbasket, but here's what we want to talk about today. Number 1, we definitely want to talk about what does inflation do to the overall real estate market, and we'll touch upon some of the other things there. What's happening in the builder market, and ultimately, how do we see Texas real estate given the certain market conditions? And so, you know, I've got my theory, which is a little mosaic theory. For those of you that don't know what that means, I take bits and pieces of information from all the things that I hear, and then I try and think of my own opinion and perspective. Tom, I assume you probably do the same thing.
Yeah, I mean, as you know, we hired an in-house economist from Penn and also from Johns Hopkins. So she has a variety of degrees, top institutions, top economist. You know, I was tired of getting up every day and reading every single news article I could find to kind of do what you just said. So we brought it in-house, and now every quarter we have about a 55-page report that really breaks down micro and macro level items, because when you manage this amount of money, you have to be on point.
I completely agree with you. And honestly, as a steward of my investors' capital, although I don't hold any of that money, I really try and look at the macro environment and really place my investors' money with certain areas. So, well, let's jump into this, Tom. You know, when you look at what's going on in the market today, what are some of the things that perhaps are concerning based on the current conditions and how it affects real estate? And obviously, real estate is a big market. There's multiple micro markets within the real estate segment. So
yeah, I mean,
what are you focused on?
Yeah, this in itself is like a 30-minute answer, right? I'll break it down as much as I can in about a minute to 2 minutes. But you know, there's, from a developer standpoint, really even a builder standpoint, we are in great times, right? There is a massive shortage of lots for building. And there, as we know, there's about a 4 million unit shortage of supply. Okay, so if you're a builder, if you're a developer, great times to be here. But that's just the money side. I do feel for the first time home buyer, affordability is out of whack. I feel for anyone that is trying to, move up. That's not easy. And now with debt costs on a 30-year fix rising, that becomes more impossible. So the moral side of it's not great. I feel bad for many people. From a profit standpoint, it's fantastic. Now, when I think about like major headwinds where we see concern, obviously interest rates are everyone's concern right now. It's crushing tech, as it should. Cost of capital goes up. But if you talk or if you hear Avi Zellman or other economists, we're just back to pre-pandemic levels. Okay, we're still at 5.25%, which is very attractive for debt. We think there's substantial risk when we hit around 7% on the 30-year fixed. So we're still in a really solid place on the 30-year fixed, and I think we'll continue to be there for some time. We believe that for a balanced market to happen, we do have to be in the 5 to 6.5% range to kind of level out that demand. So we're still very bullish. Obviously, inflation's of concern. We do see some flatlining there. Keep in mind 1/3 of the overall inflation number comes from used car sales or car sales, which are plummeting, right? So there's that. But so inflation is kind of a risk, and then supply chain. I would love to see more efforts in supply chain management from our governments. That's probably where I see the biggest risk right now is the supply chain.
Some really good, interesting comments that you've got. One of the things, obviously, we look at the demand. We've talked about this forever on this podcast about the inelasticity of real estate. A little bit of a tongue twister there, but continually, we see a lack of inventory, and traditionally in historic markets, 6 months of inventory on the single family housing is somewhat normal. We've really been sub 2 months of inventory. That number could still, climb a little bit, but still be relatively low compared to historical numbers. And so, obviously we see, a huge undersupplied market for the demand. What's very interesting is the demand side, although, we might see some short-term fluctuation or downturn in demand. Specifically, I think it's going to be more, it's really going to depend on the markets. And, I could see areas in, some micro markets of some larger, more popular MSAs, particular, here in Austin, in the Austin Round Rock MSA. There's going to be areas that may get hit a little bit harder in certain price points. But here's the most important thing. You look at demand, and demand has to do with the amount of people that are out there. And what a lot of people don't understand is the amount of younger folks who are now not just entering the workforce, but are really a large percentage of buyers. There was an article on Forbes Advisor that showed the home buying generations and the amount of makeup that they represent for 2021. 23% of home buyers in 2021 were the older Gen Y millennials, 31 to 40 years old.
Yep.
Okay. The median age in that group is 35. Now, listen to this. Okay. The second are the Gen Xers, 41 to 55. The median age in that group is 48. That's where I lie. And then you still have the younger boomers that are there, and they're probably not going to be buying so much. I would say they're probably more sellers of real estate. But more importantly, the biggest demographic of population is that younger Gen Y millennial, 22 to 30. They represented 14% of buyers in 2021. That number is going to climb. Keep in mind, peak earning years are 46 to 54. So yeah, we might see some short-term fluctuation, but these people need housing, and you're not going to rent and throw money away for anybody making $1. You'd rather own a home, and maybe it even economically doesn't make a whole lot more sense than rent.
Let's take us one step back too. that's not to say that there's not headwinds in the market. There obviously are, right? I think people who once had contracts for new home construction at a 3% clip now are at a 5.25, and they're like, uh-oh, can't afford it. Now, I talk to builders all the time, and they're telling me they're seeing no let up on their pipeline whatsoever. Okay, so there's that. We still estimate that demand will fall off between 10 to 15% from the recent hikes in interest rates. Still, we're still far, if that happens, we're still far behind on that supply demand curve. Okay. Now on your point, I'd be curious to see what you see, because what we see is that the boomers in the older generation that have current homes that usually at this age, they sell for the 31 to 45-year-old cohort, and they move to condos, retirement communities, whatever, they're not moving either. And we need those homes to come to market. And if you look at the existing home sales, it's plummeting. And it's not a matter of demand, it's a matter of no one wants to get out of their house. They can't find a house that's as cheap. And now debt cost goes back to pre-pandemic levels. And so that's why Biden camp just came out this week to talk about, hey, we recognize it's a housing supply issue, not a housing demand. Okay, so they're now going to push hard. Now, who knows what happens? They're going to push hard to pass through the infrastructure dollars into cities that are willing to reduce regulations for developers, because they recognize the supply need.
You brought up a great point. As far as new construction home sales, I just wanted to say there might be folks that actually back out. Ivy Zellman actually mentioned this on CNBC last week. I don't know. Did you get a chance to hear what she had to say?
She's great. You know what's amazing about her is that she has one view in her blogs and her news forums, and she has another view on live TV. But I'm curious to hear what she said.
Well, ultimately, she was just giving us some overall numbers on the market, as far as an uptick on cancellations from home builders. Home builders are absolutely getting crushed year to date. All publicly traded home builders are down 35, 40% year to date. But I think it's just, they probably got a little frothy. Here's the thing. One of the things that I read out of this article out of Forbes Advisor, you've got new home construction, which climbed to 6.8% back in February. That's the fastest growth that we saw since 2006. So you've got almost 2 million new home starts. That's not even going to make a sizable dent in home prices. So, the amount of demand is only going to increase, and that lack of supply still can't catch up. So single family, definitely still an opportunity. Obviously, you might get some panic as a single family home buyer. And by the way, this is your home. This is where you're going to live. Nobody wants to move. So, forever, you can think about every economic time period that we've gone through. Guess what people still need? They need a place to live. Guess what people hate to do? Number one, hate moving. I don't want to move. So they still want to create a home. It's not just about, these crazy appreciations. I think developers more than anything, may see some shakeup. But ultimately you could have a great buying solution. Here's the way that I put it, and then we can move on to the next topic. But look, if you've got some short-term disruption or loosening of demand and interest rates rising, so my cost of capital is a little bit more, here's the reality. I might have a good buying opportunity, but institutional capital is going to flood the market too. So you may not even see any of this demand if the market actually does loosen up a little bit, which maybe it is in some markets. You're not even going to see that hit because big institutions are going to come in and they're going to scoop this stuff before it even hits the market. So I don't necessarily see that as problematic. Okay. I don't believe there will be a crash. We're going to just see a pullback on the rate of growth. I don't necessarily think we're going to see a correction, but if we do, if we see 5-10%, so what? I think it's a buying opportunity. And I hate being, making these analogous statements to sports, but I just have to because I'm a sports junkie and I love that. But, if you were a quarterback and you were unsure of what the defense was going to call, you've got a couple of different plays that you might look at and you're talking about in the huddle, but you're not going to call the play until you line up and you see the defense. And so that's what I kind of look at this market, buy the asset. And at the time, let's just say you're in development, walk up to the line, see what the market presents itself. And then maybe I do, a build to rent. Yeah. Maybe I flip it. Maybe I long-term lease it. Maybe I short-term rent.
That's a great point. And this is exactly why in our pro formas and cash flows, we now have about 8 different scenarios in our modeling. And one of them, to your point, is crashing of the market, 20%, which is, no one is predicting that a 20% crash besides the one guy on YouTube. But aside from him, we look at a housing crash. Does it make money still? Yes. We look at entitled lots versus development. I mean, to your point, if you're a savvy operator, a savvy investor, you're going to be modeling out all the worst case scenarios, not just the upside. And so to piggyback off what you said, so long as you're doing that and you still make money on those downside scenarios, buy the asset.
That's it. I think still owning that asset still has tremendous advantages, and just, wait and see what the market does. I've got several, of my own developments going on, and I've got an idea what I'm going to do. And so just think a few steps ahead. And ultimately, here's the other thing too. Jumping from asset to asset may be a little bit more difficult. So I may not want to sell these assets to jump into a new one. I'm curious to hear what you think inflation does. And this really kind of jumps into our next topic, which is what's happening on the inflation front and how that's going to impact real estate. Tom, here's the question that I have for you. Okay. I syndicate a multitude of different deals. One of my concerns about inflation, obviously the cost of capital, sure. And if I'm an owner, developer of multifamily, I set the expectation for my investors to have perhaps a 3 to 5 year hold. And my cost of capital is, perhaps in the high 2s, in the 3s, maybe even the 4s. Now I'm going to sell that asset so I can get investors their money back, and my cost of capital just went up. Do you think there's a possibility that some of these operators and owners, and perhaps yourself, do you think there might be an opportunity where you say, you know what, maybe we just hold on to this asset a little longer instead of selling the asset?
Great question. So what I'll tell you, we're not seeing contagion of the 10-year note or 30-year fix to any of our debt partners. The rates are still coming in now again, this is not banks. This is like more private offices, sort of family debt funds. We're seeing it in the 8 to 11% range. And that's been consistent over the last couple of years. So no bumps in our debt structure. So what I'll tell you though, that's us. And we model our deals based on thresholds of our margins and a number of other KPIs. Not all operators are as dialed in as us, if I'm going to brag a little bit. And so there will absolutely be operators that were novice that went into these syndications, assuming a 4% refi rate or 5% refi rate, and they will be in a bad situation come here in about 6 to 12 months when they go to refi. So I don't know. There's definitely a risk, and I tell all my investors, hey, if you're in a syndication now, and I've been saying this on these podcasts, if you're in a syndication now, make sure you understand what their plan is, and if it looks bad, in my opinion, get your money out if there's any risk.
You're right. This has always concerned me about a lot of these operators who have been able to actually provide a pref rate or some sort of dividend or payback based on refi. So that is always one of those red flags that stick out to me. So that's why I'm so concerned on how they bought it. If they at least bought it at a discount to the relative market, I think it's extremely important. And that recap factor may hurt some developers. I couldn't agree with you more there. So let me ask you this. What does the builder market look like from what you're seeing currently? We talked a little bit about it as something that I read from the Forbes Advisor article. What are you seeing?
Yeah, again, generally it's strong. I think you're right. I think those hits to the stocks, the D.R. Hortons of the world, are interesting because I don't think they're seeing any headwind really. Still some supply chain, and I think that's where they're going to come up short on delivery of homes. So they're passing through some of that with price increases. Okay. Builders are strong right now, from what I can tell. I think where there's a glaring need and continues to be is who's going to come out and build the volume home for 250 to 350 over and over and over in these markets. And Lennar is doing a pretty good job of that. They've dialed in their product. DR Horton's not bad, but it's hard to build a home under $250,000. And the first, whether it's 3D printing or some sort of modular home or whatever it is, the first company that really dials that in and scales is going to do fantastic.
Yeah, this is really interesting because I was talking about this same challenge in the software as a subscription model, the SaaS model. And one of the things that we see as inflation, obviously we see the job market running rampant, right? And basically these employees, potential employees, can essentially call their shot. That's going to level off now, right? And I think ultimately what the market, and when I say market, I'm talking about the publicly traded market, things aren't going to change until these companies scale back their CapEx. And I think that translates into all businesses. Okay, it's extremely expensive for me to go out and find labor across all markets. So how do I become more efficient? What this market will do, and I think, and now when I'm referring to market, I'm referring to everything. Whatever business you're in, you are going to have to figure out how you're going to become more efficient, how to use technology to become more efficient, more cost-effective, quicker. And I think whoever can figure that out on any front, those are going to be the ones that come out ahead. So I'm not so sure on the building side what that looks like, but obviously if you can build quicker, cheaper, and faster, you're going to be able to meet that demand and ultimately reward investors for that.
Yeah. And this is all based on the idea that, hey, can supply chain support that sort of scale and growth? Right now, I don't think it cannot. And that's why I said the biggest risk is supply chain. We can do all we want to do in interest rates and, programs from the government and sort of credits from this and buyer demand that. But if you can't get a garage door for 6 months, you can't get a garage door for 6 months. That is what it is.
I really want my neighbor to get his garage door because I'm not kidding you. It's been 6 months. I can't look at this, piece of garbage plywood and it's an eyesore. And I would really like for supply chain to loosen up selfishly so my neighbor can get a garage door because it's really ugly and I'm tired of looking at it. So I really appreciate this, Tom. It's always good to get on the horn and kind of talk about this. If you guys have any questions, reach out, mflax@netequitycapital.com. I'm happy to field anything, Tom. I'm sure you are always available to talk to any potential investors or folks that are just wanting an opinion on what the current conditions look like. Where can folks find you?
Yeah, go to our website, Red Oak VC, like venture capital, redoakvc.com.